Welcome to the Broken Pie Chart Podcast, episode 303. I'm your host, Derek Moore. With me, my co-host, Jay Pestrichelli. All right, Jay, we got lots to cover. Little CPI. I want to talk probabilities of the market actually getting to 7,000. A bunch of stuff. All right, let's start here. CPI isn't at 2%.
No, it's really not getting closer, is it?
It seems to have stalled out. You know, we look at CPI core is 3.3 year over year. So that's not 2%. And Supercore, you know, you come up with new ones, of course.
Yeah.
If you don't like the makeup of one, you come up with another. That is 4.25. And basically what this is saying is that services is still pretty high. Like if you look at the core CPI, which excludes food and energy, core goods is down year over year. Core services is up year over year. So it's not, I mean, so let's triangulate back to the market, Jay. It probably means the whole, we're going to be at 3% Fed funds by the end of next year. This does not indicate.
No, you're right. They're not incented. Like the data, if they're going to be data driven, doesn't tell them they could cut. Now, look, there is a downtrend here, Derek. Don't get me wrong, right? Like I know we're kind of bashing on it, like CPI isn't licked. It's declining generally, right? If you go look at between 23 and 24, it's declining. And maybe that's just the way it goes. It takes that long for all of this stuff to kind of work itself out and level out. But you're right. It's not going at the pace that I think the Fed would have expected. 2% target doesn't seem like it's anywhere near the horizon at this point. It feels like at this point, though, the way the market is treating it is only their credibility is on the line. The market seems okay with this data. Like after the CPI data came out, the market, the futures popped in the morning. Eventually, the market sold off. On Thursday. We don't know how Friday's going to land yet because we're doing this midday. By the way, this is a fun one for us. We're recording in the middle of the trading day.
Yeah.
And we also, Derek thought he'd throw me a challenge and give me zero prep time and just say, read the data, let's talk about it. So this is ultimately the just raw data, let's go. But when I look at this, the market seems okay with it. It is slightly declining. And you're right. I think we should expect that an aggressive dovish Fed is not in the future for us.
All right. So they've lowered what? 225 basis point cuts so far, right? That's where we are?
That's where we are.
Okay. And let's say next
week. Did they
week.
do a 50 in there?
Oh, no, they did a 50, didn't they?
Okay. Yeah. I think it was 50, then a 25, right?
So 75. And then if they lower 25, it will be 100 basis points lower. Right.
Yeah, you're saying for the December meeting, which is December 18th.
Yeah, that's
right when we get there. Yep. People will have heard this by then.
Yes, this comes out Sunday. The numbers come out Wednesday, the Fed decision. So, yeah.
Yep.
And so, I mean, if they lower 25, so that actually is more lowering than the example of 94, 95 when they only cut 3 times of 25 basis points, 75 bips. And I think they stopped after 3 from memory. I'm doing that from memory. I didn't plan that. So,
okay.
I don't know. I agree, though. Like, the market seems okay with it. And, the other thing, too, is like nominal GDP is, I think, we talked about it a couple weeks ago. If we get over 5% nominal GDP, which is what we had in the 90s, that's pretty good.
Yeah, 5% on the 10-year in that scenario is not terrible, right? Like, it's like a higher 10-year is fine. I'm not saying rates are going to go up, but because that would be higher.
It should be higher. It should be. You should get paid more for taking term premium.
Yeah,
right.
You should. Well, there's a lot of shoulds that still don't exist in the bond market, right? You should get paid more for taking longer risk. You don't today. Today you get paid more for taking shorter risk, but a lot of shoulds.
All right, I want to get to earnings, and this is from, I think FactSet. So FactSet, what they did was they have a graph. And it's EPS at the start of the year, EPS actual. So what you're looking at here, I'll put this chart in when we post it on Zega Investments. What you wind up seeing is normally the earnings expectations for the coming year start out higher than the actuals. start out higher than the actuals. And 21 and 18 were sort of the anomalies. But most of the time, the point is that earnings estimates start higher and the actuals come down lower. I don't know what it's going to be. Well, for 24, 24 actually is a little bit lower than they started out. I guess this is so the reason why I show that, and first, any comments on that?
Well,
I get to the payoff here?
No. Yeah. As we look at the growth, it's growth, right? There's growth of earnings, and that's, it's a number that people refer to all the time. I think you're bringing it up here because the dig on the current market is it's expensive versus earnings. And what FactSet is putting here is kind of illustrating that, estimates versus actuals. I think, is that kind of what we're talking about here?
Like the actuals theoretically normally are lower than the estimates to start the year.
Yeah. Well, there's growth, right? And this is earnings are growing. I don't know if it's growing as fast as the market thinks it's going to grow, but there's growth here. And it's not unusual that the actual end of year earnings were less than the anticipated earnings.
No,
that
it's
seems
not.
to be the general trend.
No, it's not. And earnings expectations have gone up. I mean, all right. So why I bring this up is, so here's one of the things, like the fly in the ointment. If you say, well, the market's too high. Right now, we're currently at a 22.96 forward PE ratio. So that's the year ahead. And the year ahead is, what do we got? According to Bloomberg, $263.52 for the next 12 months. So, okay. So we're trading almost 23 times that. When people start to say, okay, I think the market's going to get to X or Y, I think it's going to be 6,500. I think it's going to get to 7,000 by the end of next year. So why do I bring this up? The expectation for the year plus one, so that's basically next December, what would be the forward 12-month, is just under $300 per share. It's $298.33. And the reason why I bring this up is, Jay, if you scroll down a little bit, I said, all right, we're basically at a 23 multiple right now. And so let's say we stay at a 23 multiple and the forward 12-month estimate at the end of next year is still 298.33. That gets you to an S&P at 68.62. So now you kind of see why I've done this, Jay. It's like,
okay, so there's two things about that. And I would say that is probably a fairly aggressive, optimistic case.
Sure.
Right? You've got not this year's earnings. It's the 1 year in a year, right? Coming in at 298. By the way, where are we going to come in this year? Right? What's the 2024 actual is what? 240. 230. Let's say 240. I'll round up. It's 239.97. So we'll say 240, right? So you're telling me we're going to go from 240 to 298, right? That's, 58 divided by 240.
Well, it's actually saying, so you say 263.52 is the estimate for the forward 12 right now.
No, I'm saying what we just went through, and then at the end of next year, we'll have another estimate. So in 2 years, going up by 58, right?
Correct.
Yeah.
Correct.
So that's 12% a year. That's okay. That's not unreasonable now that I think about that. That's still 12% growth is pretty good. It'd be great if GDP was 12. It's not the way it works. So that is if you get that. And then, Derek, you put on what's considered historically to be a high multiple of 23.
Yes.
So you've thrown on a very high multiple. You've thrown on aggressive growth. And look, all of those things have happened before. Don't get me wrong. It just seems to be on the high side for that 6,800 number that you're talking about for the end of next year.
All right, so let's bring this a little more. So 23 times the year plus one estimate, 68.62. If we keep the 23 multiple, but earnings are 10%, the expectations for earnings are 10% less, it's 61.75. If they're 10% more than the current year plus one estimate, it's 75.48. So the earnings estimates can grow, the multiple can grow or contract. The estimates for earnings can grow or contract. And this is why it's so hard, as you'll hear at the end of December when we do our prediction show. Like, yeah, I would agree, Jay. Like 23's, it's a high multiple, but it doesn't mean it can't stay high. It doesn't mean it can't go higher. But, if you're 16, you're like, oh, we'll probably get more multiple growth. If we're 23, it starts to be a tougher argument.
It's a tougher argument. And look, I don't know, the world could change. The mix of the way profits are generated could change. We're going to have a new administration. You've got maybe a different tax policy. There's a lot of things that could impact this. I would tell you that the break-even number, so now I love this fundamental stuff. Let me look at option stuff. What do the options tell me, the break-even is on this? And when I look, it's about, plus or for the end of next year, based on the S&P, it's plus or minus 800. So 6,800 lines up nicely versus where we are today. So, so that's what the market is projecting, the one standard deviation move. The expected move should be in the range of plus or minus 800 from this level of, we'll call it 60-40. 60-50 is the S&P level right now.
Up or down.
Up or down. It could be up or down. But the up part is what lines up nicely with this. It could also be down that much. By the way, what's that math look like to be at 5,200, with those earnings, right? 5,200 divided by the 298 number. It's a 17.5 multiple.
Got it right in the chart there, Jay. You don't even need to do the math.
Did you do it already? How about that? I did it.
Yes, scroll down. I gave you the whole multiple.
This is what happens when I don't read the notes ahead of the meeting. But yes, it's exactly it. So I think there it is. There's your range, plus or minus 800. The market says you just made an argument for plus or minus 800 as well. There you go. Now you decide, do you make the bets that's in there or outside of that?
I'm going to deviate for a second. And people, I had a question recently from a listener, and you can always send those to derek.moore@zegainvestments.com. That's DEREK.MOORE @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments, you got to figure out how to spell that correctly on your own. So we had a question, and where is it? I'll just summarize from memory. It's like, hey, I hear you guys talking about probabilities. How are the probabilities calculated based upon options? And then what's the probability of the market getting, I think he said 7,000. So 7,000, there's no December 31st options for 2025 on the SPX. But Jay, it looks like the one's December 19th. The probability, according to ThinkPipes, which is Thinkorswim's institutional trading platform, it's about 14.5 probability of the market being
closing
the money. Yeah, the probability of touching is about 29.3%.
Yeah, usually the probability of touching is double the probability of closing.
Right, you can get there, but it doesn't necessarily stick there.
Yeah,
at expiration. Yeah. You want to kind of touch on that a little bit? I know that's like an hour discussion.
Oh my God, do I want to touch on that? I couldn't ask. You couldn't have teed me up better. So So options, the pricing of options implies a lot of things. You hear us talking about the implied volatility, the implied move. So there are some things that are very kind of matter of fact about option calculations. And by the way, so the answer is it all comes from option pricing. So what goes into option pricing? There are things like how far in the money is this option? That has intrinsic value. There's things like how many days until this option expires. There's things like what are interest rates right now? All of those kinds of things go in. But the one thing, like those are known entities, right? I know how many days it is between now and December 19th of 2025. I know the interest rate. I know if an option is or not in the money. But the thing that you don't know is this thing called implied volatility. That tells you how much is implied in the price of the option, how much it's telling you the market will move because of the premium or discount or the extra premium that an option is trading at. So if you think the market is going to go up to 7,000 using that example, but the option is really cheap and it only costs you a few bucks to buy it over par value, then you'd be like, great, I'll pay more because I think it could go up more. And so what happens is that like supply and demand works as people are buying and selling options, as the market is buying and selling options, the price moves like anything moves when there's trading. Well, guess what? The higher that price goes up, like today, if the options move and nothing changed between interest rate, days to expiration, and if it's out of the money, nothing changed there, but the option prices go up. It's implying that investors are willing to pay more for that option because they think there's a greater chance it will happen, right? So if I was to, I could think of like a very simple case here. Let's take Tesla. That one's been fun in the news lately, right? So Tesla is trading at $424 today. Next week, if you thought, yeah, I think it could be trading at, $430, right now that option will cost you $11. But if I told you, well, you only have to pay $1 to maybe have to be profitable over 430, you would say, yeah, I'll take that because there's this implied move. You're willing to pay more. At some point, you go, oh, no. That option's too expensive. Let me sell it. So the buyers and sellers are kind of running their models to determine if an option is expensive or cheap. Ultimately, it's buys and sells against each other. That's reflected and dictated in the pricing of the option, and that gives us the implied move. So now once you know how much, I'm going to call it the volatility juice, is in the option, you can now turn around, and there's some fun math that we won't go into with calculus that'll let you determine like, oh, based on how much extra is going into this option, it tells me what the market thinks is probable to happen because of the buys and sells. If no money's flowing into an option that's out of the money, the market is giving it a very low chance of happening. If a lot of money is going into an option that's out of the money, it says, hey, the market thinks there's a greater chance that this move will happen. This is why you see around earnings all sorts of probability discussions based off of the option pricing, because people are taking bets. Maybe they're looking at the chart. Maybe they're looking at the fundamentals. Whatever it is, they're deciding that there's a certain price, and they're deciding if the option is worth it or not worth it to buy or sell.
We could spend 10 hours on this, by the way. We won't.
We can write a book about it, Derek. Some of us might have.
Yes.
Yeah.
Maybe we'll write another one. Maybe we'll put something out for pre-order soon. Okay. Yeah, I mean, that's the thing. And it's, like you said, it's the option math. The interesting thing is if the market sells off and volatility goes up, like in theory, your probabilities of getting to the number actually could increase. But I'll leave that for another time.
Well, because people are throwing money into the options in the way that's right. They're buying calls, they're buying puts, and it is weird, right? But it's where in a bear market, all of a sudden, you're right. The chance of like getting to new highs ends up being definitely different than when the market is kind of sanguine or just kind of chilling out at the same level. It's weird because now it's just big movements are getting priced in. It's the movement and the pricing of that movement that ends up like rippling through and helping you be like, well, maybe in a year we're higher than this. It's just, you see that,
To round out the discussion on just the valuation, just to give, kind of both sides of the coin here, we said, 23 times if the estimates stay the same for forward 12 months plus one, which is basically the 2026 sort of forward earnings, 23 times 68.62. If the multiple, the forward P pulls back to 20, it would be 59.67, and pulls back to 18, it's 53.70. So that multiple is pretty important as far as the valuation. Like small changes in the multiple are big changes in theoretically. What you don't have in there is the buybacks, because remember, if there's a lot more buybacks, you could have less earnings but the same earnings per share, or you could buy back and have more earnings per share just because you bought back shares. You could have new entrants coming into the index. So kind of leave it there, though. I just wanted to give both sides of that. Jay, one of the things, you know what? I did not put down who this was. I got this off Twitter, but it's kind of the number of pullbacks per bull market. And for example, pullbacks of 5% or more, 23 times from 87 to 2000, we had a 5% pullback. So that's a long period. According to this, 4 times from 2020 to 2022, and from 2022 to current, we've had 5 pullbacks of 5% or more. And this person's saying the average is 8. So
you're saying, hey, 5% pullback if it happens, very normal in bull markets for that to happen. And you're just,
I don't like this chart already. No, because it's some bull markets are 2 years. So if you had 8 in 2 years, that's more significant than 8 in 6 years. All right. The point is, like, pullbacks of 5% are normal. We could have one. We might not. We might have one.
So what do you do if you think the market's going to pull back 5%?
Well, I mean, you use one of our hedged equity strategies.
Yeah, that's right. You don't do anything. You're already prepared, right? Yeah. So that's the goal of hedged equity and managing your risk up front. It's too expensive and too hard to guess in the heat of the moment at the time and all the decision points that are happening when you should be hedging or not. But for us, it's always hedged, right? Keep the hedge on. That's a strategy. And then manage the hedge. Don't manage the exposure to the market. Stay invested.
What normally happens is people are not hedged. They get their risk tolerance goes up as the markets go up. And then they say, well, I don't want to really hedge because I will have to give up something. And normally they say, I want to give up something when it's really cheap. And then all of a sudden the market does do a 5% pullback. And then they decide, oh, you know what? I do want to hedge. So now I'm putting on a hedge lower than I would have and more expensive than I would have. So it's sort of better to be hedged all the time. And maybe you sleep better at night. Maybe you don't. Maybe you have loud neighbors or something. I don't know. All right. So this is from Visual Capitalist. I thought this was interesting. And the national debt is definitely in the news. And one of the things I always hear is that, what happens if China or Japan were to start, or China specifically, were to start liquidating all of their treasury bonds? You would crash the treasury market, yields would spike, all this stuff. So at the end of 2023, our total debt was $34.4 trillion. So that includes debt held by the public and debt held like intergovernment debt. That's like, Social Security owns its own. Jay, do you know, and you can see on the chart, that China at the end of 2023 only owned 2% of the total
of U.S. debt.
$820 billion out of the $34.4 trillion. Who knows? I'd have to look where it is today. But I think this is sort of, it's not that it's a myth, but I think this narrative that, what if China sells all their, $820 billion, the Fed could absorb that tomorrow. Fed has $5.2 trillion, or they did at the end of 23.
Yeah, this is, I thought it was higher, and maybe because in previous periods it was higher, but if this is from 2023, that's obviously fairly recent. I think I remember during the debt crisis, the talk was China held 10% of our debt, right? So this is, this is interesting. You know what? Maybe answer the question: why does China hold U.S. treasuries anyway?
I would think, well, one, not all countries have deficits like we do, and so they have to put their cash somewhere. I haven't looked at what their debt or surplus is in China, but the other, it deals with the dollar.
Yes.
I think that's where you wanted to go on this.
That is where I wanted to go. Yeah. Good job. Without planning, you got there.
Page all the way down. You'll see a trade-weighted dollar index and a dollar index. Dollar index in blue, trade-weighted in white, Jay. If you scroll down towards the bottom.
Yeah, I got it. But I love that you post these charts. That way people can kind of follow along.
Yep.
Well, it's because they want dollars. They need some dollars, right? They actually... there's the I think between trade and other transactions, they need dollars. And so maybe that's all that they need. I guess they don't need too much more. I wonder if this is a result of the, first Trump round of tariffs and stuff and lowering their exposure there. But look, I think I
think it used to be higher. You're right.
I think it was notably higher. That'd be interesting to get a chart of that. But thanks for bringing this one up. So the myth is not so bad. So what I think where you were going, and we could jump to the dollar conversation if you want to, but which was like, if there is a trade war, this is not a lever that an adversary will be able to pull.
I don't think so. I don't think anymore. The Fed could step in and start buying treasuries again.
Sure.
Yeah. All right, go with the dollar.
All right, dollar. So I asked you to pull a chart of the dollar because, we've talked about a rising dollar makes it harder for U.S. companies to have profits, right? It impacts things like the price of oil, right? Takes less dollar, higher dollar means you need less dollars to buy, a barrel of oil. So usually it's bearish on commodities. Same with gold. But look, we hit an all-time high last week. We had some, testing of it, flirting it with this week. Yet the dollar has bounced nicely and is up. And so I just, it's something that we brought up before in the past, and I just wanted to point out that not all correlations are always 100%. In this scenario, I think with the dollar is going higher, and the market, despite of it, is still pressing higher.
Yeah, that has been, because you remember, what was it, back in 2022, maybe 21 as well, we kind of looked, and when the dollar was down, the market would bounce up. When the dollar was up, the market at its lows was when the dollar was at its highs. And on a trade-weighted basis, so trade-weighted, by the way, for anyone who doesn't know what that is, it's basically taking a look at all the trade partners of the U.S. and then putting a weight based upon the dollars that we trade. So if you trade more,
if you do more with less with Lithuania, their currency has a lower impact on the dollar index. I know that.
Probably the euro, right? Yeah. Aren't they in the euro?
I know. I just made up a small country.
Yeah. But if you look at the blue line, the dollar index, that's more Euro-centric, where the white line, the trade-weighted index, and we're actually butting up against the old highs, right around 125 of the trade-weighted index. And that, to me, is actually more important, because we may not trade with the companies on a weighted basis as much. Again, the dollar index, the one you see on TV, is more Euro-centric. There's Japanese yen in there. So this is one of those things. It's a problem when it's a problem. I think we're out of the zone of comfort, though. And you know it when you see it. It's like, I think you're going to start seeing that some of the international companies complain in their earnings that, but for the dollar strength, our earnings would have been X. So...
I was going to go another way, that, as we're butting up against the, former resistance here, right, at this high, if it was to pull down, if it was to go lower, if it was to retrace, then that would be positive for the market. That's where I wanted to take it. Like, hey, despite the dollar, the market's still strong. You could get this tailwind of, just maybe, 5% pullback here over the next, year or so that could notably change that dynamic and be a bullish tailwind.
Yeah.
All right.
All right. Jim Bianco put out something, and the source was the Conference Board and Bloomberg. Conference Board, consumer confidence expectation stock prices increase. So they survey 3,000 households, random sample of approximately 3,000 households. And in October of 24,
I never get these random household phone calls.
I never do either. 56.4% of these people said stocks. What is this? What are they saying here? Hang on. Oh, yeah. They're saying expectation stock prices rise.
Price increase. Stocks will be up. This is just an up or down question.
Yeah. And so it's binary. The highest. December of 17 was 51%. December of 03, 47.2. December 99, 47.7.
And we're at 56 right now. It's the highest on this chart.
Yeah. By the way, June of 22, 25.5. So this is sort of one of those contrarian things. Like, when everyone thinks price is going to go down, then maybe it's time to buy. When it's this high, is it contrarian saying it's too high, more likely? I don't know.
Well, let's see. December 17, 2017, I assume that's what it means. It was the previous high, and the market was fine up until the last quarter of 2018.
Yeah.
So you had a good run for 2018, and then, 19.
So you're saying it's going up next year. Got it. I'll pencil it in. All right.
John, I didn't say that. I know you're listening. John's our compliance officer.
No, I don't know.
Which, by the way, I asked John if he enjoyed the podcast. He very much does. He has to listen to all of these, by the way. These are all compliance reviewed before you're hearing them, but he says he enjoyed it. Glad you enjoyed it.
I wonder if he listens to it at like 3 times speed.
I asked him. He said no. He says, he goes for a run and he puts it on and he listens to it, and that's it. Yeah. He said we really, are incenting him to go for a run. He can't wait to the next Broken Pie Chart podcast, and then he goes and he exercises. So now you have John's health on your responsibility list, Eric. I'm kidding.
That's something I don't take lightly. Okay, so anyway, these are surveys, and it's 3,000 households.
Yeah.
Whenever you see something that's above where it's been, and this only goes back to
I would say it's definitely a contrarian indicator, right? When everybody thinks something's going to happen.
We'll let you know in a year whether they're right. Okay, SpaceX valuation. Charlie Bolello put this out on Twitter. And so, all right, so why am I bringing this up?
SpaceX, huh?
Yeah, so we haven't really had any really big IPOs of late. It's an interesting phenomenon because normally when you get, if the market was truly like, I'm just making this up, like, let's say like, oh yeah, it's a bubble, you would expect a lot of IPOs to come out, a lot of IPOs with maybe not a lot of earnings. Typically you see that in euphoria. Look, I don't know what the market's going to do. That's why we buy and we hedge. But SpaceX, if it came out, I think it would be in the top 35 or top 25 valued companies in the S&P. And their valuation as of December of 2024 is $350 billion.
$350 billion.
Yeah,
for SpaceX.
Their valuation. I mean, they're taking, I'm sure, venture capital and private investment and things like that. And I guess their latest round was at $350 billion.
And I think this probably came right after they, landed that, oh boy, I'm going to show my. Yeah, they really caught the rocket. It's like, right, they caught the rocket coming back, and then so that the reusability of the and the cost efficiency of space, getting into space and coming back looks like it could be improved, right? And I think that was the big deal for them that shot a lot of this valuation up. Look, if you think about the long game, this is a real interesting play, for sure.
Yeah. I'm not saying you should invest in it now, but it is, I think, is an IPO standpoint, like a company that would come out, probably if they had positive earnings. I don't know if they do, but they're selling to the government. Government usually overpays for stuff, right? So that's probably a good business to be in. I don't know.
Sure.
Yeah, I mean,
especially when the owner is also heading up the committee to check government spending.
Oh, that's a good point. The Doge.
Doge checking the SpaceX budget.
Department of Governmental Efficiency, not the Dogecoin.
Oh, yeah. But, well, we know that lined up nicely for him.
Yeah.
No
All
coincidence.
right, speaking of government, okay, let me kind of set you up for this. You're like, what is he even talking about?
What didn't I read yet? Let's give it to me.
I think it was a couple weeks ago. We never talked about it, but there was a story about how, what is it, like 1.9 or 2% of taxpayers pay 50% of the taxes in the U.S.
Yes.
And so the mayor's office, the New York City, I think, Office of Controller, whoever deals with the taxes. And Mayor Adams had said, the mayor of New York, 51% of our taxes are paid by 2% of New Yorkers. And, people looked at that and they actually put out a report. And what the report said was in 2020, filers with an annual gross income of $500,000 or more, representing 1.6% of all filers, paid 49.2% of the city's personal income taxes. So it doesn't include like S-corp taxes or property taxes. Those are other ones, or corporate taxes. And one of the things they said was, 2.1% of the New York City's earners take home 43% of New York City's income. So I looked, and let me go through this, and then I want to get your...
Well, let me just pause there, right? So the concept of paying your fair share is a little skewed there, right? I mean, that's why I wanted to bring this up, right? So if 2% are earning 43% of the income, but paying 49% of the taxes, those are the numbers that you just quoted, right? I would say that is, they're probably overpaying, right? I get it that the 2% it's fine. They're making the money, but they're paying a greater percentage than the earnings on of the tax revenue. So I'll pause there and I'll let you get back to it. But that was the thing. I was like, man, it always just irked me, the fair share comment. It was just a cop out with no numbers behind it. And when I saw these numbers, I was like, we should talk about it.
Yeah, I mean, the New York City, I think it's the comptroller. C-O-M-P.
I think they're a comptroller, yeah.
Yeah, I don't know. Somebody can check that for me. I actually don't send me emails on that. You can just check it. But I know one of the controller or comptroller, whatever that. I'm sorry to the New York City comptroller or controller, whoever that is. So the other thing is, former Senator Phil Gramm had actually written a whole book on this, and it gets into the idea, to your point, who's paying the fair share, but it also goes into wealth inequality or whatever that means, income inequality, those types of things. And this is older now. I wish I had a newer one, but the CBO, the Congressional Budget Office, which is supposed to be a nonpartisan agency. They just take numbers. And what the interesting thing is, a lot of times when you look at the difference in income, it is pre-tax and it is government programs. So, income transfer programs. And so income before transfers and taxes, the highest quintile, the ratio of the highest quintile to the lowest quintile is much greater than you say, well, then what about all the government assistance stuff? SNAP, the food program, housing assistance, tax credits, all that type of stuff. And then you also look at pulling the taxes out of everybody. What you wind up seeing, and for those you can't see this right now, I'll probably put this in the when we post this on our website, is the difference between the lowest quintile and the top quintile is not as much when you account for those things, Jay.
That was a long way to get there. I gotcha. So the summary is when you include all those data points, that really the gap between the high earners and what was the low, all of those groups, the different groups, it's not as vast as it looks like on the surface.
That's right.
Yeah.
Yeah. I guess I just could have said that, but I wanted to explain it.
No, I know. How you got to it was helpful to hear.
Maybe not. I don't know. Maybe it was helpful. So, but yeah, what's interesting too is that you think about New York City and people were moving to Florida. I think Mayor Adams, I'd have to look and see in the report how many actual households that is. But I think it was it 61,000 people or personal income tax filers made up the 1.9%. I'm looking in here. Oh, 65,000. So this is Adams said, do you know, quote, 65,000 pay 51% of our income taxes. So like New York, if they lost half those people, that would be a pretty big hit. Or if they lost them all, I don't know.
Yeah, I mean it's that migration's happening in California too, right? The California to Texas migration is.
Oh, to Arizona. Yeah, in my neighborhood, we have people who've come in from California.
Yeah. Well, look, but you still have state tax in Arizona, correct?
I think we're the lowest of any state that actually charges them. I think we're flat tax of like 2.5%, if that.
Texas is 0, Florida is 0.
Yeah.
So maybe that's where that move happens.
But I mean, real estate taxes are more. So homeowners taxes, I believe, are higher in Florida, or at least in Texas, I think they're higher than here. Anyway. All right.
By the way, I found that article that I sent you about this, the not so fair share stuff, right? So, and this looks like federally, it looks like in 2022, the top 1% of earners earn 22% of the country's reported earnings, yet paid 40% of the income tax. Feels like they're paying their fair share to me, and then some.
Remember, they were just going to do a flat tax and give you a postcard. What'd you make? Send it in. Remember that?
Yeah, somebody ran on that. Like that was their whole presidential. Like, here's what you're going to get if you vote for me. You're going to get this postcard. You're going to put 5 numbers on it, and that's going to determine your taxes. You
mean a politician didn't live up to their? Well, look, I mean they have.
Well,
to
they didn't win.
To
so there you go.
Oh, they didn't win. Well,
no.
that would have been interesting.
Yeah.
All right, Jay. Let's see. I knew I had something else. Do you got anything else?
You wanted to talk about Broadcom earnings, didn't you?
Yes. What are you talking about?
This is what happens when we do zero planning. Yeah. So Broadcom had its earnings last night, Thursday night. Did very well. Again, AI making its way into the conversation. I think as soon as in the what do we call it when they talk about it all, like the presser, like when they get together and they talk about it after they released the stock got up. Yeah, the conference call. Wow. It's Friday.
Okay.
The stock right now is up 19%, after that. I don't know where it'll end for the day. So the 1 day change. And again, it's an AI story. And I think they said something like they'll see 65% growth next quarter in their AI chips. There's a lot. Right. And the chart is just, if you look at the chart by the way, Broadcom has a strange ticker, AVGO.
I still can't get used to that.
Not BRCM. Weren't they used to be? Wasn't they used to be BRCM? So, okay.
Yeah.
Sure, there's a fun story there that AI could tell us all about if I asked it. But that was it. So it's just another AI story here, pushing the whole semiconductor index up for the day as well. I think earlier in the day I saw a video was up. NVIDIA's down now. Maybe it was like, maybe Broadcom's going to take market share, right? So NVIDIA's down 2.5%, while Broadcom's up 19%. So just some interesting dynamics at play there. But, I think I told you this, right? Maybe it was on a different podcast. I think about, our son's generation and what, I think you and I could say the big change in our generation was the advent of the internet, right? There was no internet, when I went to college.
Yes.
I laughed. There was no email when we went to college. Like, how is that even possible?
I had a friend of mine who was with Infotech, or I don't know, there was some like minor, and he told me about how you could send an email to the White House. So I did. I sent an email.
You get no response, I'm assuming?
No, it looked like it was like the old DOS, it was a green screen with a bunch of characters. He set it up for me and I wrote it, and he's like, I'll let you know if I hear from, I never heard anything.
Well, anyway, so when I think about
actually, do you remember how long it took to print something? If you went to like at the first computers and the printers, and how much
the dot matrix and the daisy, yes. Yeah. And they had the little on the side of the paper you would tear off the little perforated sides because you had to feed it through. Mm-hmm. Yes, I do remember that. Well, I wasn't going down the memory lane. I was just trying to identify what I think the current generation, right? I don't know if your son is Gen Alpha or Gen Z. Mine's Gen Z. And I had thought it was going to be defined by crypto, like they were going to be the crypto generation. I think they're going to be the AI generation, yes. And more. And look, I guess both of those two things can happen at once. I believe, one of those things you believe in, and one of those things you think is, yet to be defined. But I just think that's more and more is coming here. I think it'll be obvious. That's when we look back and be like, yeah, of course AI has all these impacts for what we do every day and just making us more efficient, right? I asked when we were at Ameritrade years and years and years ago, decades ago, I had asked one of the older guys there that was, I don't know, was the chief operating officer. I said, what did you do in like the 80s, like when you had no email? And he said, we had a bunch of voicemails and you'd have to write stuff down. And it was just, you took multiple people to be as productive as we are today. And, while it may not be obvious why connecting to the internet would be something that made us super, super efficient back in 1990, when you think back now, the thing is, the thought here is that AI will make us that level and then some, a bigger jump in productivity and efficiency when it really integrates into our everyday life like the internet is today.
I'm of the case, so you've heard me talk about this book before, Carlota Perez's Technological Advances in the 20th Century and Deployment of Capital. I'm messing up the book. I'll put a link to it in the show notes. But the last major, so you think about like steam engines and the cotton gin and all these different, I think AI is potentially one of those things. It could be. I could be wrong.
No, that's the way that's the way it's being welcomed on Wall Street. Yeah, no doubt about it.
By the way, somebody asked me recently, they had NVIDIA. Now, I don't know what's going to happen to NVIDIA versus the stocks index. But they said, hey, what if NVIDIA loses their dominance in chips? Should I switch to something of the SOX index? And, you look at NVIDIA in the SOX, it's 9.77% of the weighting. I think this is as of yesterday. Broadcom is 9.43, AMD is 7.47, and down the line. You can Google that. But it is kind of interesting. Like, NVIDIA is definitely they've had the most growth, I think. I'd have to go back and look. But it is an interesting idea. Like if you are, and I don't know where semis are going to land, tomorrow, much less in a year. Nvidia, we buy, we hedge. But it is interesting. Like if you wanted to try and diversify, I mean, the stocks, it's an index. You've got different players in there.
Yeah, that index is up. By the way, without naming any names, maybe there are option funds that use options over, semiconductors. Maybe that's an interesting fund to look up. But where you have income, right, with options and income on a semiconductor based build. I was just thinking about this. Like, you're right, Derek. Like, you having the index, yes, maybe you don't get your gains could be muted, but you also take away some single stock risk. Like having an ETF, just generally, like using an ETF because you think, hey, chips are a big deal, they're going to be a big part of the AI revolution if there is one. Then having an ETF like SMH or what's the other? I know
SMH is one. SMH weights higher than the index, though. So I think Nvidia in that one's over 20. But it goes back to, like, imagine you own Nokia, but you said, well, I think Nokia is certain to be the leader and the beneficiary of all this, and then it turned out not to be. If you had owned an index of cell phone makers, and who knows, Apple might have not even been in there. Back when. But the point is, like, if you pick this right, if you're like, oh yeah, everyone's going to have a phone and everyone's going to have an operating system, you'd be like, oh, Nokia and Microsoft. Easy. No, it wasn't. It's Apple and Samsung, and it's, Apple's iOS and Google Android. Not so simple sometimes.
No, it's hard to pick the winners here. So, like, the index is up there.
All right, last question for you. Does this mean... I think I saw Broadcom hit $1 trillion market cap.
I mean, they could have, being up 20% today.
So does that mean eight companies now are $1 trillion or higher?
Yeah, well, let's see at the end of the day, and then you'll actually be able to get that info. But I think you could be right.
That's something.
I mean, yeah, it's up right. It was up over 20 at one point today. So, yeah.
Yeah. All right. I have two things that I watched. I'll be honest, though, I fell asleep through a lot of it. There's something on Netflix, and this is a horrible recommendation.
You already gave a great recommendation, whatever it is.
But it was about these two people who hacked and stole what wound up being like $4 billion worth of Bitcoin, and they were seemed like two clown YouTubers who were putting out, like really bad rap videos. And apparently they got arrested for...
Yeah, they got caught. Yeah, I remember the story. Yeah.
So anyway, that's on YouTube. It was sort of interesting. But I fell asleep, so I'll give you a half recommendation on that. I don't know.
So drink coffee before watching that. Yeah. What's your other one?
I was tired. We're doing stuff. So the other one is I watched Christmas with the Campbells. Just to be clear, this is not a Christmas movie, a family Christmas movie. Vince Vaughn is the producer on this. It's on Hulu. And... it's basically a parody of, those Hallmark movies. I don't know if your wife watches them. Mine does.
Yeah, of course. There's one, yeah.
Total parody where it's like an R-rated version of a Hallmark Christmas show. So do not watch this with the kids.
Christmas with the kids.
It wasn't the best show, but it wasn't like my wife watched it and she's like, I didn't think it was that good. I'm like, it's not for you. It's for me making fun of Hallmark movies. So
did you laugh?
I laughed. I was like, I can't stand those Hallmark ones. Like they drink, it's like they don't even try. Like a train goes by in the background and there's no sound from the train really, or like they're just swinging around. They just get coffee and they're like moving around their hands. Like it's clearly an empty cup. That's it.
That's your dig on Hallmark movies.
No, I have a lot more.
There's a lot of else to dig. All right. Well, what I've been watching has been Yellowstone, which is almost the new season's almost done. I think we have the finale this weekend. Good show, but a better show by the same guy that co-wrote Yellowstone is Landman. Brand new show with Billy Bob Thornton. I know you like him. Mm-hmm. So I think there's been 4 episodes out so far. Some other notable actors are in it. John Hamm's in it, for example. Demi Moore's in it. So I haven't really seen much out of her yet, but Landman, worth watching. It's on Paramount Plus.
Better or worse than Tulsa King? Because I like Tulsa King.
Okay. Right there. And in some ways better.
Okay.
And Billy Bob Thornton's just great. Like you had given me the recommendation Goliath, right?
Yeah, the lawyer show. Yeah.
And he was so good in that. He's just as good in this.
Yeah.
It's a long way from Sling Blade.
All right. We have more trading to do today, so let's end it there. Thanks, everyone, for tuning in. We're going to do our prediction show, I guess, in 2 weeks.
I guess we should work through that, man. It's got to be soon.
Yeah. No, it's got to be soon. All right. Thanks, everyone. Thanks, Jay. We'll see you.